The Fed cuts rates by 25 basis points, but more importantly, ends QT. What does it mean for liquidity and Bitcoin? Welcome back to the Bitcoin Layer. I'm Nik Bhatia. Today, I'm joined once again by our research associate, Demian Schatt. Demian and I are going to discuss the Fed's announcements, what's been going on in the repo market over the last week, and what's coming for the Fed's balance sheet, and of course, what all of that means for asset prices. Demian, what is your first question coming off of the Fed's rate cut and announcement that they are going to end QT?
Nik, I first want to ask you about the statement that the Fed put out in their press release. They said the committee decided to conclude the reduction of its aggregate securities holdings on December 1st. The committee is strongly committed to supporting maximum employment and returning inflation to its 2%. Why does that mean that QT is ending?
Yes, so the Fed has a portfolio of securities. That's what they're referencing there. That portfolio, we call it SOMA. The SOMA portfolio is the system's open market account. It's the portfolio controlled by the New York Fed. Remember that the Federal Reserve is a system. It's a system of banks, regional banks, and a board of governors. The board of governors is more the Washington, D.C. influence over things. The regional banks are extensions of banking companies. And the New York Fed, which plays a central role in this system. The New York Fed is the regional Federal Reserve Bank that has the control over what they call the desk, or the actual trading of securities such as repo, or in QE or QT, you are buying treasuries and keeping them somewhere. So that portfolio is called SOMA. When the statement says we're going to conclude the wind down of our portfolio, what it means is that the bonds that we have in our portfolio today, that quantity of bonds is going to now hit a minimum, and we're not going to go below that level. We're going to stop having a runoff of securities. So now, if you want to read the first part of that sentence one more time so that I can point out for viewers and listeners the key phrase there.
The committee decided to conclude the reduction of its aggregate securities holdings on December 1st.
Yeah, reduction of aggregate securities. So it owns securities, which are bonds. It was reducing the aggregate securities in its portfolio. The way that it reduced the aggregate securities in its portfolio is that what are fixed income securities? They have maturities. So when those maturities come due and you don't rebuy, your aggregate securities decrease. And that is what QT is. It's letting securities mature and not doing anything to replenish them. So what the Fed is saying is that we're done reducing the aggregate securities. What it means is that every time something matures and we get cash, we're going to put it right back into a bond. So therefore, to keep the aggregate securities constant instead of reducing. So that's the technical jargon to understand why that means end of QT. It just means securities were going down, QT, now securities will stop going down. So every time something matures, we will replenish. That's the key for the end of QT. It's now all about replenishing securities that are going to mature. And there's nuance between treasuries and mortgages, which we can talk about here. I'll actually just make a note to make sure that we get to it, but I'll let you ask your follow-up question.
Well, just real quick. So when they're letting these bonds mature, the size of their balance sheet is shrinking?
That's right. Exactly. Okay. Remember, the balance sheet is assets and liabilities. The assets are what we're thinking about here. They own assets, and as those mature, you lose the bond, right? You get cash, but you lose the bond. Well, with the Fed, when the Fed owns Treasury securities, when they lose the bond and the government repays the Fed, that reserve is, or that TGA balance, it's the liability of the Fed, it's destroyed. So the asset goes away and the reserve on the other side, or the TGA balance on the other side, gets destroyed. That's the accounting mechanism that shrinks the balance sheet of the Fed during QT. All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio, and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archLending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app, and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com, use code TBL for 10% off.
So I want to ask you about this article by Joseph Wang. It's called Balance Sheet Dominance. And it's explaining, related to repo rates being high and the Fed having to employ the SRF. It was explaining that because the government is now issuing so many treasuries, that the market then has to absorb and it has to use the repo market. And now the Fed is effectively being forced to step in to help bring repo rates down by unleashing some liquidity. And because the Fed still controls the policy rate, but would you say that it has sort of lost control of its balance sheet a little bit because of the size of the fiscal deficit that's going on?
Yes, Joseph Wang is a fantastic analyst, and we'll link this article in there. He did it without a paywall for this particular one. I think because of the importance of this meeting and trying to understand QT and what's going on with the Fed's balance sheet and fiscal dominance, which is basically what your question is about here. So first of all, I agree with Joseph here wholeheartedly in his conclusion. The quantity of T-bills is very high and will continue to stay very elevated. That's because of a few things. Number one, the Treasury Department has continued the previous policy of not terming out the debt, which means not issuing 10, 20, and 30-year bonds in greater sizes. Why did the previous administration and this administration, why are they both doing that? From a pure supply and demand perspective, if you issue a lot of 30-year bonds, you're increasing the supply, and if the demand is the same, you're gonna have to knock the price down, which means higher rates, steeper curve, expensive 30-year borrowing. So it makes sense to us that Treasury doesn't want to issue a lot of 30s. But the US is taking on a lot of debt on the aggregate every year. And in the taking on of that debt, you have to decide which bonds or bills to issue. So both administrations have gone with, let's do bills because it doesn't hit supply. There's a liquidity argument that we've discussed. We don't have to rehash that in that, duration, issuing duration is the private hand has to take on risk, and that makes them less able to take on risk elsewhere in the market. So the portfolio effect, we don't have to get into all that today. But what Joseph is saying is that the issuance of bills and the sheer quantity of them is the core issue that the Fed is responding to. And I agree with that, because as a lot of bills are issued, the financial system has to be able to take them down. So who's taking down these bills? Banks, investors. If banks take them down, we don't really... If banks take down T-bills because their customers are the recipients of the government spending, it all balances out, and we don't need a lot of repo financing to bridge that gap. But if the bills are not being taken down, all of them are not being taken down by the banks, somebody has to buy these bills. So who buys them? Well, investors buy them, money market funds buy them. Now, for the buyer to come in and buy these bills, they need a warehouse for a few days, weeks, until they can find their buyer. Where is this warehouse? The dealers. The dealers then need to finance all this T-bill inventory through the repo market. So when we look at our money markets monitor, which we'll throw up on the screen for you guys, we see SOFR volumes go up and up and up over time, over the last few years, as this SOFR metric gets off the ground. What it means is that you have all these treasuries in the market, and more and more of them are being warehoused in the dealer inventories and need to be financed in the repo market. So Joseph's point is that there are so many bills, of course they're going to end up in repo. They have to be financed overnight, because the inventory doesn't just get magically taken down by the system. No, dealers have to carry a lot of that inventory until money market funds buy it from them. And if money market funds don't buy it from them, then some other investor or bank has to take them down. And maybe the bills have to cheapen, meaning they have to get higher yield to attract some buyers. That's supply and demand. But when people talk about money markets as plumbing, what they're talking about is the fact that bonds don't just get issued and by the issuer and purchased by the buyer, and that's the end of the transaction. There's warehousing, there's inventory, there's trading. And repo is what greases all of that plumbing. The Fed sees repo rates climb, and they know the reason: too many bills. That's it. And so it's two steps in that it's too many bills. The bills have to be financed in repo. The repo rates are going up because obviously they got to attract they have to attract the cash. So they have to bump the rates up every night. I'll give you 1 basis point more, 2 basis points more. Please lend me the money. Please lend me the money. I'll bump up the rate. So the Fed watches SOFR rise. They know it's too many bills. They see SOFR volumes also. That's why you got to look at SOFR rates and SOFR volumes. So we show you the money markets monitor to show you that we're watching that the quantity is going up. Now, the quantity went up all year, and SOFR, was okay. It was flat, which means more bills didn't put pressure. But now you're at a point where, yes, the bills, they're putting pressure because now the rates are going up. It's getting more expensive to finance that inventory. So in conclusion, why was SOFR going up? A lot of bills, not enough funding. What is the one thing that the Fed can do the Fed can say, well, we'll buy some of the bills. That's definitely one thing that they can do. They announced that today, that they'll be taking the mortgage-backed security maturities and using that to buy bills. So remember, aggregate stops going down. So all the mortgage-backed security principal and interest that they get, because they're the bondholder. So when the American home borrower pays principal and interest, it goes into the Fed's account. Their bond shrinks because less principal, and they will take the cash from you, the American home buyer and borrower, and they will buy bills with it. So that's one thing that they can do. And another thing that they can do, which will come next, is start increasing the size of reserves in the system and increase their aggregate securities. So they have to end QT before they can start increasing the balance sheet. So they didn't want to announce both today. And that's basically the main takeaway. What was the drama here? We knew they were going to announce QT and thought that they might announce a beginning to increasing the balance sheet. So, but they only announced the end to QT, didn't announce any start yet.
Is the way we view QT going to change? Because they're going to have to be injecting liquidity into the market for all these T-bills.
So QT now is over in that you can only describe it as QT if the aggregate securities are declining. So the tightening era is done as of the end of November. So then it'll be flat. So you won't be able to call it QT because it's not. You won't be able to call it QE because it's not going up yet. But then at what point do they start increasing the balance sheet, and how do they do it? That's why there's this descriptor, which I would agree with. I wouldn't argue with it in any way. They call it not QE. This is this GDP targeting QE that I've been talking about, where they'll increase the size of the balance sheet, but say, oh, we'll grow it at 3% or 6% based on GDP growth. And in that way, it's not QE, but it's increasing the balance sheet size. So that's what not QE means.
So this article was arguing that the Treasury is now setting the balance sheet, not the Fed. Would you call that fiscal dominance?
So that, and I generally agree with the way that he's describing this, that the reason that repo rates are going up and the reason that the Fed has to stop QT is because there are too many bills. That is a function of the Treasury, which is the fiscal side of the equation. So how can you argue with describing that as fiscal dominance? You can't. There's no footing to argue that, because if the Treasury wasn't issuing so many bills and stuffing the repo market, like the SOFR volumes themselves speak to this issue. So if SOFR volumes weren't climbing, it means there weren't all these bills and other treasuries to finance in the market. Then would repo rates be going up? Maybe not. And if repo rates are not going up, then there's no reason to necessarily stop QT. So if one is to describe this as fiscal dominance, the key word being fiscal, and the concept of fiscal dominance meaning that it's Treasury's policies that are influencing or have control over the Fed, you cannot argue against that. That's what the word fiscal means, right? It's Treasury bills that are running the show on the Fed's balance sheet. Now, the other side of that is banking behavior, because if there are 3 trillion in reserves and Fed funds volumes are low, which means Fed funds volumes are how you measure if banks are lending reserves to each other. So this is the Jamie Dimon Fortress lending out to Wells, Citi, Bank of America, maybe some regionals. So this is the Jamie Dimon concept here. So Jamie Dimon isn't the Treasury and has nothing to do with the fiscal equation. He's JP Morgan. So if Fed funds volumes are low, it means that Jamie's banking neighbors are not calling him emergency saying, hey, can you lend me reserves tonight? But that there are dealers and other repo participants that are calling him up and saying, hey, can you lend me your reserves for repo? And he's saying no. So the other side of that answer is, well, maybe this is a banking behavior issue. This is a Jamie Dimon, JP Morgan operational risk issue. How do we influence JP Morgan to loosen up on the lending of their reserves to help the plumbing, right? Because we talk about plumbing. Well, you got this one plumber, Jamie, with $1 trillion, and he has so much power to grease this and that. He can let go of 10 billion here. Remember, the standing repo facility, you said it's off zero, right? 8 billion yesterday, 10 billion was the morning. I didn't see what the afternoon number was today. 8 billion, 10 Jamie has that. So it's not a problem of scarcity, explicit scarcity, because those are small numbers. Why did that participant go to the Fed to borrow 10 billion against 7 billion in mortgages and 3 billion in treasuries? Why did that participant take 10 billion in securities to the Fed and said, will you lend me money tonight for it? Instead of Jamie Dimon saying, I'll lend you some money. What is the reason they went to the Fed and Jamie didn't let go of the reserves? And when I say Jamie, of course, I want people to understand I'm talking about JP Morgan, the bank that has the number one quantity of reserves in the system, and their operational risk team.
Well, it must have been cheaper at the Fed.
Bingo. But it's not just the rate, because it's reputation too. Because eventually we'll find out that you used it. I think the lag is 1 year, from what I remember. Maybe somebody wants to pop in the comments and tell me that they moved it to 3 months, or that it's not at 1 year, or maybe it's 2 years. But from my memory, it's 1 year after we'll find out who used it. So there's a reputational reason that you wouldn't want to go. Jamie's not going to blow up your spot and tell everyone tomorrow that I lent this party money in the repo market tonight because they might be on the brink or they might be in trouble. He's not going to do that. It's his, customer or client. He's making money off of the loan. So he's not going to do that. So you ask me, is it fiscal dominance? My answer is yes. But the reason for it being no is this whole JP Morgan issue, that there's a behavioral component to this and a banking component here that would be the devil's advocate answer.
But if they have the reserves, if they have enough reserves, why wouldn't they lend?
It could be as simple, it could be diabolical. The diabolical is that you are trying to squeeze your competitors, right? If they can't, remember, repo is how you live to fight another day. So the whole system does collapse if the market doesn't get funded on a repo basis on the overnight. And that's not an exaggeration. That's why the September 2019 repo crisis is so important, because if the Fed didn't stop it, everything does fall apart. And that's why they put in their standing repo facility. So they know that it's a crisis. So they put a facility to effectively say, hey, we won't let it go to crisis. We'll just be the lender. So the whole banking system lives to fight another day through repo. The Fed has backstopped repo. Why won't JP Morgan lend out the reserves? The diabolical is that they're trying to squeeze the competitor. But the simple answer is that their risk model says we need to keep 980 billion, I'm making up the number, 980 billion in reserves tonight to make sure that tomorrow's settlements or our T+7 day settlement expectation are all met, plus a margin of 50% so that we don't get caught off guard. Let's just say that's what their risk model spits out. Let's say that they're at the level, so they're just not going to lend. The operational risk model says you need 980 billion at the Fed tonight to make sure that your next 7 days of any interbank settlements are covered, plus a margin, plus our insurance margin, plus our FDIC pay in for the next 3 years, whatever it is, right? I'm not sitting at the bank, but I know that they have a minimum. And that's where we are. That's why the prediction that they're going to end QT and stop reserve drain is a very easy prediction to make. It's obvious to people that have been, that are observers of the repo market. When Jamie stops lending, the Fed has to do something. Because the Fed can't call, that's the point, Damian. The Fed cannot call Jamie Dimon and be like, it's time to lend your reserves. It works the other way around. Jamie calls the Fed and says, hey, I've stopped, so it's your turn. I've hit my minimum. Heads up.
What I'm trying to understand is this cyclical, or are we now approaching, like, now the Fed is just going to permanently have to be expanding its balance sheet because of the Treasury issuing so many bills?
Remember, Damian, and I'm going to ask you to help us throw up our chart of the history of the SOMA portfolio, where I have my labels QE1, QE2, QE3, QT1, and then QE4 and QT2. This isn't cyclical. This is a 16 year story that has its genesis year right around the time of Bitcoin's birth was the fall of Lehman. This changed everything. Before Lehman, there was no excess reserves. That concept didn't exist. QE and QT didn't exist on this continent. It existed in Japan. They invented it, but it didn't exist here. So it's a good question, and the answer is categorically no. It is not cyclical. You had let's call it 7 years of QE post Lehman. A couple years of QT failed spectacularly with a repo crisis in 2019, a pandemic, an unprecedented second wave of QE, and then the second QT, which has ended not in a spectacular crisis, but in a way that it's so easy for me to go on and do a video last week and say, hey, repo rates are creeping up. The Fed is now going to be at a point where they see standing repo being used like an alarm bell going off, and then the siren going off, and one at a time. It's like, standing repo used for the first time. on consecutive days. That's an alarm bell. Then SOFR at the ceiling, another alarm bell. And then they get around and they call Jamie and like, hey, what's going on over there? JP Morgan, in as few words as they can, basically say, yes, a higher spread to reserve IORB, which is the SOFR to IORB spread. That's not going to really move us because we're at our minimum. And the Fed says, oh, okay, we know what we have to do. So it's not cyclical. It's like, 7 years of experimental QE, couple years of QT crisis, pandemic, unprecedented QE, and then QT not a crisis here in QT2. And that's why today was so important. It was easy, and then of course we read the JP Morgan report last week, which came the day after my video. So we were all actually ready for this. If you've been a money markets person and lived through the 2019 repo crisis, the standing repo facility, and looked at the way that the Fed has described QT over the last year, this is all very well telegraphed and not a crisis. This is, if people watched me on What Bitcoin Did with my good friend Danny Knowles, I opened up by saying it's not a crisis, but it's worrying, and the Fed is going to come in and say, hey, we're going to stop so that it doesn't turn into a crisis. And that's exactly what happened. And very well telegraphed.
How does Bitcoin behave in this world? Are inflation expectations just going to change forever? Like we're just going to be seeing more inflation than we've ever seen before over the next couple decades?
So I think that the Fed's balance sheet has not been and won't be the driver of inflation. That's what fiscal dominance is teaching us. It's the fiscal side. The Fed is just an assistant to the government. The era of bank bailouts, which was the post-Lehman, that decade, that 7 years of QE didn't lead to inflation. It was below 2% the whole time. So QE to bail out banks, which is a Fed and bank deal, that crony capitalism concept between banks and the Fed, and the Citibank bailout and the AIG bailout and all the AIG counterparties and all of the bailouts in 08, 09. It led to asset price inflation, but no consumer price inflation. And I'm talking about the index, not the essentials like healthcare and education, which we saw outpace, of course. And, it actually widened the gap between, it widened the political gap also. This is something that you and I have talked about with the younger generation. And everyone from the Ron Paul to the Occupy Wall Street, it's a lot of frustration with some of the same things, like banker bailouts. So the current inflation wave that we've had since the pandemic is a breakdown of global supply chains in the way that we know it, and the way that the U.S. government had to respond to that breakdown, this U.S.-China relation. That's the source of the current inflation. It's not the source of home prices going up faster than wages over the last 60 years. That's a different phenomenon. But this current consumer inflation that has taken hold and is far above 2% and trending that way, that itself, I believe, is likely to persist because of fiscal policies, not the Fed. The Fed is simply like, remember your first question. If Joseph Wang says QT is over because the Treasury is just issuing a lot of bills, well, why are they issuing bills? It's for all the reasons, not just because they're not issuing 30s. Why does the Treasury issue bills? They have to pay the military, Medicare, Social Security, and then they have to go and do their whole Make America Great Again agenda with all of these types of investments and other tax cuts, which have to be funded because you don't get the tax revenue, so you have to issue another bill to pay the next guy. That's the government. What's the source of the inflation? It's the government. What's the source of broad asset? I should say just broad inflation during the 1960s and 70s, the Eurodollar system. So we travel through different eras of time. The team you and I were talking about this morning about history books, 500-year timelines. So we have to know what timeline we're addressing, what cycle we're addressing, what concept. You asked a great question about, is this QE, QT thing cyclical? No, it's not. But the business cycle is cyclical, and monetary policy cycles are cyclical, by definition, of course. Political cycles are also at play here. Geopolitical cycles are also at play. The US-China relationship and the US response to China and the rise of China that we're seeing right now, is that likely to be the primary source of structural inflation over the next 5 to 10 years? I would argue yes. That's where you have to look for some of these things. Damian, we've covered a lot of excellent topics today. I want to leave it there so that people can go check out what the Fed did and think about not just the fact that they cut 25 basis points, but that they can't wind down reserves anymore because there are too many bills. Why are there too many bills? Because the fiscal hand is at play. The U.S. response is with us, and that's the main story. When we're talking about soybeans and the American farmer, or we're talking about the U.S. devaluing the dollar to invest in technology, or we're talking about JP Morgan's $1.5 trillion investment commitment to 27 key industries that the United States needs to be able to domestically support on their own 2 feet. That's where our attention is. And we need to bring, I call it little 25 basis point cuts and bring them into the context of what we care about, which is global macro, Bitcoin, and its role in our growing future. Demian Schatt, thank you for great questions, great analysis today, and coverage of the FOMC meeting. I'm Nik Bhatia. We'll catch you guys next time.